Welcome to Investors Hangout once again. Every week we come to you to talk about something which is important. It affects your investments. Try and answer as many of your questions, and the whole idea is to help you understand investment issues better so that you can invest better. This is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about the classification system specified by SEBI, the stock market regulator, which regulates mutual funds as well, has come up with a classification for open-end mutual funds for mutual fund companies to follow. Today it is possible to have any kind of mutual fund, open-end mutual fund, as an investment option. SEBI has gone about defining that what are the various funds that mutual fund companies can offer, and if they already have too many of them, they have to clearly earmark which category it falls into, and they have to merge the funds. Either they have to merge the fund or reclassify them, change them, do whatever, come up with a plan, discuss it with SEBI, slot their various funds into the classification system which SEBI has specified, and need be merge those funds if they have too many funds falling in the same category. So how does it affect your investment? This is a anxiety which investors are faced with. Many investors have written to us asking what happens to their investment if they have invested in a large cap fund of one fund company, and that fund company has many large cap funds, and they see in the classification system. So let me just specify what SEBI has gone about doing. SEBI has said that mutual fund companies can have 10 kind of open-end mutual funds. This is first and foremost the multi-cap fund, then the large cap fund, large and mid-cap fund, mid-cap, small cap, dividend yield, or value or contra fund, one of these two. A focused fund, a fund which concentrates in a specific number of stocks or specific sector. Clearly defined thematic or a sectoral fund, and a ELSS. So these are 10 kind of funds which are possible. Of course, a fund company can have multiple sector funds, multiple thematic funds. Besides that, 16 kind of debt funds. So 16 kind of debt fund are far too many, but the advantage of this exercise is that you will clearly know what you are going to invest in. I would have liked, and of course, investors can ignore many of, if I look at these categories, these are overnight fund, liquid fund, ultra short term bond fund, low duration fund, money market fund, short duration fund. So when I look at this complex classification even specified by SEBI, because most mutual fund companies actually follow some strategy like this, or a specific focus with their debt fund, this might be useful for them. It will actually enhance the comparability of various funds, but most investors can do without this complex classification. The useful category from the debt fund is liquid fund or ultra short term bond fund for your money of few days or few weeks. Maybe the short duration fund or the corporate bond fund to enhance your return, or maybe the dynamic bond fund, which has it is almost like the equivalent of a multi-cap fund of an equity fund. This is a fund which actually tries to derive the best return available from fixed income instruments without you bothering about where you want to be. You are delegating this responsibility to the mutual fund manager. So the 16 kind of debt fund, I don't want to list all of them, but 3, 4, 5 kind of fund, and they will be extremely comparable, because what SEBI has gone about doing is large cap should be invested where, mid cap should be invested where, multi cap should be invested in a certain proportion. So you will have absolute clarity in terms of what funds are doing, what they stand for, what they will do, and what they will not do. Another thing another category which has come is which got very clearly defined is the hybrid schemes. These are very useful funds for investors, because they give you wider diversification. They normally invest in equity and debt in certain combination, ranging from 10-15% going up to 65-70% for the balanced fund. They are also very tax efficient, because They are many of the hybrid funds, the balanced fund or the equity income funds, by their very design, they are able to provide you far greater tax efficiency despite having a meaningful fixed income allocation. So the fixed income allocation provides you the stability. But being a hybrid fund, because the law defines hybrid funds, any fund which invests over 65% into equity will be entitled for the equity tax treatment, which is which is concessional. Besides the convenience, you don't have to rebalance yourself. Most investors, conservative investors, should start with hybrid funds. They should invest in a fund, and they don't have to bother about rebalancing, because in a good market, equity goes up. If you realize your equity gains, you could be faced with one, you have to act, and then you have to worry about taxes. Here you don't have to worry about any of those. Besides this, you have a wide range of, every fund company can also offer a retirement fund and a children fund. Because I think, this was not needed, because any fund can be a children fund if you are thinking if you are investing for a child. But many investors, it becomes easy to sell a fund for many naive or, uninitiated investor who will have this goal in mind, investing for retirement or investing for their child. Besides this, any fund company can offer as many index funds and ETFs and fund of fund offering foreign, investing in foreign markets. So these are far too many. But the key benefit of all this is about, you will have comparable funds. When you will be looking at a multi-cap fund, you know that all these funds are going to be multi-cap as defined by SEBI. If you are investing in a small cap fund, you will know that these funds are, the set of small cap funds are strictly comparable, because the moment a fund company slots its funds into that category, it has to adhere to the broad guideline specified, that what is small cap. So earlier there was inconsistency of definition of the various nomenclature followed by fund companies. Now there will be consistency and comparability. So this is one of the first advantage of this regulation. The other is that, it will affect some funds. Of course, it is still some time when fund companies have to get into a discussion with SEBI in terms of how they want to follow a roadmap. AMFI has come up with some clarification, has sought some clarification or suggested few changes. Let's see what happens. It is unlikely to be, unlikely to change any meaningfully from whatever has come in the notification so far. This will translate into, a situation where some fund companies will be faced with a situation that they will have to merge an existing fund with another. But it is unlikely to have a big difference. It is unlikely to have a big impact on investors, because our tax laws have been changed in the past, in recent past, whereby a fund merger will not, cause a tax incidence for you. Earlier it was not so. If two funds merged, so if your fund was actually merging into another, if a fund in which you have invested was merging into another fund, then it amounted to redemption of one fund and purchase of another fund, which meant that if you were faced with a short term gain, if your investment in the older fund was less than 1 year old, you will be faced with a short term capital gains liability. No longer. A fund merger will be considered as your initial date of purchase, will be considered as your date of purchase, and whenever you redeem your investments from the merged fund, it will be considered as your date of redemption. So, and if you cross 365 days, it will be applicable. There will also not be any, of course, there was also a securities transaction tax applied, which in many cases fund companies used to bear that cost. But securities transaction tax, even now, I think will be borne by the fund companies, and because this is a situation which is not, triggered by investor. So in fairness, it will be borne by fund companies will bear that. Besides that, it will the securities transaction tax has become very nominal for it to affect your returns. These fund mergers will translate into a situation that some of the big funds will get even bigger. So there could be some implication on the performance. I still worry about many funds becoming very big will be an impediment to their performance, or they will lose their flexibility. It will also be impacting the strategy followed. So we will see as and when it comes by. But first and foremost, there are not going to be too many fund mergers. At worst, I think 10% of the actively managed open-end funds, though there are too many funds, but all these rules applies only to the open-end fund. So it might have a bearing on many small funds, and which will get merged with the bigger ones, and one has to see that will it really impact some of the bigger funds. And we will keep you posted. We will be taking a view on these fund, the impact on investors those fund performance resulting from these fund mergers. How do these fund mergers happen? Effectively, it amounts to redemption of your fund at the then NAV on the date of merger, and purchase of the new fund. So you will become the owner of a new fund when these mergers happen, based on the comparable. So if you own a fund whose NAV is 20 rupees, and if you are going to have, and you have 100 units of those, so you have 2,000 rupees worth of investment in one fund, that is merging with another fund whose NAV is 40 rupees. So you will have half of those units, and the worth of your investments will remain the same on the day of the merger. So there will be a corresponding investment made, and it will almost be like selling a fund and buying a new one. What should investors do? For now, don't worry much, because not much to do, and we will see as and when it happens, and we'll keep you posted. So this is one big regulation that has come about. It is going to affect some funds, and don't get anxious about this. And most of the funds which will merge, they will be of similar kind. They will be managed by the same team. If it's an outstanding fund, we have to see that what is going to be the impact on some funds which are turning very big, and their strategy does not support or is not conducive to managing a very large fund. In many of the debt funds, it will benefit them, because some of the debt funds will actually merge, they will turn bigger, and it is a business of economies of scale. Many of the equity category will also benefit as a result of turning big. In my understanding, the large cap funds can actually derive the advantage of scale. Some of the expense ratio can also come down as a result of some these fund mergers. So net, the key benefit is it simplifies. You will have greater clarity in terms of which fund you are investing in, and some funds will have greater economies of scale. The negative of this, one thing, we still will have too many fund categories, but that, I guess, is a constraint which SEBI operated in. So now we will get on to the questions that you have about this issue.
Thank you, Dhiren. This first question comes from Tanmay, and like many other investors, he is also concerned about the size of the funds post merger. And though you've talked a bit about that already, but Tanmay wants to know what should be the triggers that he should watch out for before deciding to exit a fund once it becomes too large as a result of some of these mergers.
Yes, this concern is fair, and I think most investors should worry about when some of the mid cap funds merge, or when some of the small cap funds merge, because this is where the fund managers will have to operate in a constraint, or it will be turning big will be an impediment to their performance. But don't jump on this beforehand. Let's see what happens. Let's see how funds are classifying their funds, because many funds would like to wriggle out of it by reclassifying their funds or restating their strategy, because many fund categories have been specified, and many fund companies will not have as many funds. So by repositioning their funds, they will be able to avoid fund merger. And the few funds which will be faced with that situation, I think one has to worry about the small. If you are owning a great small cap fund, and that is going to be constrained by and if the fund company has few small cap fund which will get merged, you should worry. But we will take it as and when it comes.
Next up, Mr. Bhargav says that till now ELSS perhaps was the only special category of funds with a 3-year lock-in, and it came with the tax exemption. As a result of this new regulation that has been announced, are there any modifications or additions to the tax exempt category of funds?
No, there is absolutely no change in the tax exempt category of fund. ELSS remains the way it is. In fact, some fund companies also have multiple ELSS. they are unlikely to merge. In fact, fund companies have stopped selling. Fund companies actually emphasize sale of only one ELSS. Rest of the funds, they exist because older investors have invested their money and they continue to continue to get managed. But fund companies do not get money in more than one ELSS as of now, and there is not going to be any change because all these funds, ELSS, are not allowed to merge because it requires a CBDT clearance, because you got the tax concession, you got the tax break for investing in these funds, and as a result of these fund mergers, the CBDT doesn't want to get into any complication, or it will require that clarification. So it will not. ELSS remains the way it is. Even the multiple companies having multiple ELSS funds, they are unlikely to merge.
Next up, Mr. Chaturvedi asks, by when can clarity be expected on what would be the new merged set of funds be, and would they get an exit option without any loads or charges implied on them if they want to exit?
Yes. Uh, I think it will take a little longer. It will take about 1 to 2 months for these things to clarify. Right now, AMFI has sought some clarification and suggested some changes. Let's see if SEBI agrees to any of it or clarifies things. And after that, fund companies, at least the larger ones who have too many of these funds, how they go about repositioning their funds, and they have to sit, agree, and classify their funds. So all this exercise will take about 2 months. Yes, any fund merger or any such thing triggered by as a resulting from this regulation will be will provide investors an option to exit without any load. Any such any statement of purpose or change in fundamental attribute of a fund or a fund merger is always followed by always provides for no load redemption.
Next up, Mr. Paresh says that since this SEBI rule is applicable for only open-ended schemes, are there any implications for closed-end funds and what happens to them?
Yes, these rules are applicable. These rules will apply only to open-end schemes. Closed-end funds are completely unaffected, and fund companies can happily launch closed-end funds the way they used to do.
Moving on, Dr. Agarwal says that can one remain invested in a closed-ended fund even after its maturity?
No, it will be a missed opportunity. If you are invested in a closed-end fund, then take your money out on the redemption on the maturity of the fund, because if it lies there, it will not earn any return.
Moving on, Mr. Janardhanan says, how are the growth options of monthly income plans and debt mutual funds taxed?
The growth option of monthly income plans are taxed exactly like debt funds, because the tax laws specifies that any fund which has less than 65% into equity should be treated as debt fund. And if you have invested in a growth plan of a debt fund, if you realize your money anytime before 3 years, then all the gains will be treated as short-term capital gains and will be taxed at your marginal tax rate, which means the year in which you realize the returns, if it is less than 3 years, all the gains, if you invested at 10 rupee and if you are realizing 12 rupee per unit, the 2 rupee gain that you have earned, it will be added to your income and it will be taxed at your tax rate, if you fall into 10% or 20% or 30% depending on that. If you hold it for 3 years, it will be indexed and it will be taxed at and indexed gain will be taxed at 20%. So this is the law.
Next up, Ashok asks, are diversified, multi-cap and dynamic categories of equity funds the same, and if not, how do they differ?
Multi-cap and dynamic fund from an equity context are different. Multi-cap funds actually claim that they will remain diversified and almost fully invested in equity at all times, whereas some of the dynamic funds, they are claiming that they will be investing largely in equity. It will be reasonably diversified, but it will be dynamic in the sense that it will change its equity complexion as well as some allocation to fixed income depending on the market conditions. So if the fund manager is very apprehensive about the valuation, he can well have 25% into fixed income or maybe 30% into fixed income. It will retain its equity character. Whereas The multi-cap funds, they are going to be fully invested with a reasonably diversified portfolio or the flexibility of investing across the market.
Next up, Rajiv asks, what is your advice on infrastructure theme funds? Is it the right time to invest in them?
Infrastructure funds have always looked attractive, and they have been reasonably disappointed whenever they have looked very attractive. So I would say that investors should avoid investing in any such thematic fund because it's a very broadly defined theme. If you look at infrastructure funds, if you exclude technology, pharma companies, and consumer companies, any fund can, any of the infrastructure funds actually have their portfolio like that. Excluding these three sectors, it becomes an infrastructure funds because they are very loosely defined. Then infrastructure funds, emphasizing infrastructure companies, they have had their ups and downs. They have been extremely disappointing for all those investors when we had a rage about infrastructure funds in 2008. So stay away from them. They are, it is meant for any simple investor looking for a diversified portfolio should consider, the multi-cap fund and other things. Another reason why you should avoid an infrastructure fund. Any diversified fund can emphasize infrastructure companies in its portfolio without constraint. But an infrastructure fund will have to, because we have seen a phase of market where FMCG or pharma or, technology companies, they did well and rest of the market did not. And infrastructure funds could do nothing about it. They had to remain invested in a set of companies which will excluding these. So, providing your fund manager a greater flexibility is a better idea.
And for the reasons that you mentioned, perhaps investors can avoid just about any kind of thematic fund, isn't it, Dhiren?
Generally speaking, yes. But only, if an investor is having some specialist understanding, some thought, conviction, belief, think of, something like, in fact, some of the thematic funds turned out to be a blockbuster. Think of a auto or a transportation and logistics fund, which was a blockbuster. And somebody has some specialist understanding, but most common investors will do well to avoid any sector or thematic fund because that is what you buy a mutual fund for, diversification. And that is why you choose a good fund manager who will emphasize the right thing and avoid the wrong ones.
Next up, our next viewer asks, is there any fund that gives 20% returns throughout its tenure from the date of inception?
There are many funds which have been able to deliver 20% return over a 10-year period, over 15-year period, but none of these funds are of a kind which have been able to deliver you 20% return every year. That is a catch. If you invested by way of SIP, you would have earned 20% return in about many funds. 50 to 70 funds would have delivered you this kind of return. But there would have been a phase of the market where your money would have gone down by 30%, 40%, and that is the catch. If you don't have a long-term horizon, and even if you get lucky with a great fund manager, you will have those ups and downs, and the downs could be very unnerving. So that is the whole story of equity. You will get better return, but you will get it in a very erratic manner. 20% annualized return year after year is unthinkable, but 20% return over a 10-15 year period is fairly approachable. Of course, that is in the past. I don't know about the future. I think investors also need to moderate their expectations because the return from other asset classes, including equity, is a function of what is the interest rate, what is the fixed, what is the inflation, what is the fixed income, what is the risk-free return that you are deriving. We have been in the past we have had an economy where the fixed income were fairly high, inflation was fairly high. So even equity premium or equity returns were reasonably high, and the premium on a great portfolio turned out to be even higher. And that is what these funds have been able to deliver. That may not be the case in future, as we have got 3-4 years of recent economic regime where the RBI talks about inflation targeting. They have also been able to control inflation in a not them, but variety of factors contributing to controlled inflation. Fixed income rates are coming down. They're stabilizing at a relatively lower rate in recent past, and so equity returns are bound to come down, but that is not necessarily bad news because your effective real return will still be high, though it may not be 20%.
And perhaps over here, Dhiren, it is the discipline of an investor that matters even more than the fund per se. Because a lot of funds might have delivered those returns, but if an investor has not followed the principles underlying equity investing, probably they would not have been able to ride through this return
Yes,
cycle.
absolutely. The real secret of deriving this 20% return from a good fund or even from an average fund is basically sticking to a plan. If you're making your investment through SIP, the real reward comes only to those people who don't panic and stick to a plan. Because if you panic and don't stick to your plan, you will buy and you will generally not do your SIP. You will buy lump sum when the market gets at a fairly higher levels, or things become relatively easy when the markets are doing well. You tend to invest without with reasonable confidence, and that may not be necessarily be the best time to invest. Likewise, when markets tank, when markets fall sharply, you tend to stop your investments, and even worse, you take your investments out, and that is when you actually make your losses permanent. So it's very important. In fact, this 20% return over a longer period of time has been derived only by those investors who have stuck to a plan, who have continued investing and not panicked.
Our next question comes from Kishore. He asks, is it a good idea to keep the emergency corpus amount, say expenses of about 6 months, in a liquid fund instead of keeping them in a savings bank account?
Yes, absolutely. The it's a good idea. It's not only a good idea. You have far reasonable convenience. The emergency money will be earning slightly higher return, and if you are not faced with any emergency over the next 3 years, then that money lies there, and it will be all the returns will be virtually tax free, because it will yield higher return than the money that you will earn in your savings bank account. Not only that, today it is possible to invest in a liquid fund. For example, the Birla Active account, if you have that, online enablement whereby you don't have to really worry when you need your money back. If you invest in a liquid fund, and if you use that app on a smartphone, you can make your redemption request, and the money comes virtually in some time, up to 50,000 rupees. You get your money back almost instantaneously, or in a span of half an hour to 1 hour. That is something, so it is without any huge compromise on convenience. It is a great idea to be enhancing return on your idle money you need to access anytime, and without any compromise on the convenience.
Next up, Rajesh says that he has earned 74% return from his fund investments, and he wants to redeem only the gain component from his investment while keeping the original investment intact. How can he do that?
uh, you can do that. You can, if you invested 5 lakh rupees and it has gone up by 75%, so 3.5 lakh rupees of gains, you can take a part of the money out, but make sure that it is more than 1 year old. Otherwise, the gains will be taxable at 15%. If it is from an equity fund, which it is likely, 75% return will come only from equity funds. So be conscious about that, and then next have a plan. What do you want to do with this? If you have derived, if this has come from, if you have a goal in mind, by all means take the gains out, or take all your money out if you are achieving a goal. But if you don't have any such plan, don't try to time it, because maybe it is about time that you should draw a plan for yourself. Work on an asset allocation plan, work on a methodical SIP method, start investing regularly, work on an asset allocation so that 20% of the money you can put it in fixed income, and you will rebalance it every year or so. If you do that, and if then you are redeeming a part of the gain, if it is more than 1 year old, it's an excellent idea. If you are doing it just because you think that the market has gone up and you need to take out a part of your gains, maybe uh, you should not do that, because markets are very unpredictable. Markets can sustain their momentum uh, while you might be scared of the market right now, by their levels right now, or markets can actually correct. But without having your methodical plan to address these issues, and the only way to address this issue is having an asset allocation and having a rebalancing plan.
Our last question for today's session comes from Jagdish. He wants to know on which day of the month are value research ratings updated.
Value research uh, fund ratings, they get revised at the end of the day, end of every month. So the last working day of the month, the value research fund ratings gets revised. And as you know, uh, our ratings are not very volatile, but they do change. And the ratings are based on 3-year performance of each fund. So till a fund is at least 3-year old, they don't get rated. And ratings are a completely quantitative model, driven by a completely quantitative model. It does not reflect any of our opinion. We do not sit and decide on the rating of each fund. It is based on the risk adjusted formula. So we calculate the risk adjusted performance of each fund and allocate. The top 12.5% get 5-star, the next 22.5% get 4-star, the middle 35% get 3 stars, so and so forth. For detailed methodology, look at our website. And the ratings are primarily quantitative, and they are computed. His basic question, they get revised and updated on the last working day of each month.
Thank you, Dhiren. Any
Thank you
closing
very much.
remarks?
Yes, SEBI's intention to simplify investors' life has brought about some meaningful changes. You will have various kind of funds, and fund companies will not be able to offer you any fund beyond the list specified. Funds will become more comparable. This will translate into some immediate action from fund companies, whereby they will be forced to merge some funds with other funds they have. And so we will see as and when it happens. Don't panic on this. This is a streamlining exercise rather than a big disruptive thing. So we will discuss about it, and we will guide you as and when we are faced with that situation.
That's all we had time for today.
Thank
Thanks
you.
everyone for joining in.